the best of Money Matters. Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market ended the day, the biggest movers, and of course the sectors and the companies to watch. But as always, a quick recap of some key movements. Well, Singapore shares were down today as investors continue to monitor the escalating conflict in the Middle East between Iran and Israel. So the Straits Times Index dropped 0.33% to 3,898 points at about 11:32 a.m. Singapore time, and that is with a value turnover of some 414 million Sing dollars seen in the broader market. But let's take you through some of the closing numbers. We do see the STI ending just marginally in the red, down 0.08%. The magic number to look at is 3,908 points, the closing level for today, 3,908 points. Now, in terms of value turnover, that's 1.04 billion Sing dollars. Gainers, though, outnumbered losers 246 to 226. Top advances for today, GMH USD, Asus and ST Engineering. And top decliners for today, we've got for you Charisma Energy, DBS and Shangri-La Hong Kong dollars. Then in terms of counters to watch, we've got a number of REIT counters, Suntec Reit, ESR Reit, Sabana Industrial Reit and Acrophyte Hospitality Trust. Now, why so? This is because ESR Group, which is the sponsor of Suntec Reit, ESR Reit, Sabana Industrial Reit and Acrophyte Hospitality Trust, all four of them, it is expected to delist from the Hong Kong Stock Exchange on the 3rd of July. Now, elsewhere from shares of SGX-listed oil and gas counters surging amid a rally in oil prices to market expectations ahead of that slew of central bank decisions out this week, we've got more corporate and international headlines in focus. And joining me today is Kelvin Wong, Senior Analyst at OANDA. Kelvin, welcome to the show.
Hey, hi. Good to hear from you again, Tian Tian.
Yeah, great to have you back with us. And Kelvin, let's start with the Singapore stock market.
Sure.
How did the STI fare today? And also, if we look at oil and gas counters listed on the SGX, Rex International, RH Petrol Gas, they were up more than 6% at the open today. How far can that positive momentum be sustained?
Sure. So let's take a look at the performance of the benchmark Straits Times Index. So I would say that our local benchmark is pretty much resilient despite this ongoing Israel-Iran hostility that may not be so close of ending pretty soon on a near-term horizon. Why do I say so? So if you look at the onslaught that taken shape on last Friday, the STI is only down by negative 0.3%. And they actually outperformed the benchmark U.S. stock indices, which is down by more than a percentage point for most of them. In fact, all of them, all the major for U.S. stock indices. And also on today, Asia session, yes, we see an intraday loss of negative 0.6%. But however, towards the end of today's Singapore stock market trading session, the STI managed to survive again, where we start to see support coming in at 3,900. And this 3,900 level is pretty of a key near-term support level. It is in fact a 20-day moving average of the STI, where every time it hit this 20-day moving average since 22nd of May this year, there is much of a support coming in to allow losses to be trimmed off towards the closing session of the STI. And one thing interesting over here is that we're talking about momentum of energy stocks. Yes, energy stocks momentum may continue to persist, at least in the near term. Other pretty interesting sector or component stock that I'm watching in the STI is those defensive sector. Or defensive components, I would say. So in fact, why STI managed to actually trim its losses towards the later part of today's Asia session is due to we have these three defensive component stocks in the STI, which is ST Engineering, Keppel, and Semicorp Industrial, all up by more than 1%. So I would say that ST Engineering is up by 2%, Keppel 1.9%, and Semicorp up by 1.7%. So that is able to negate the so-called cyclical sensitive banking stocks, which is DBS, OCBC, and UOB, that is facing a short-term negative feedback loop at this juncture.
And don't mind me if I could zoom in on the oil and gas counters listed on the SGX, like Rex International, RH Petrol Gas. They rose likely because of that increase in oil prices, and that's, of course, driven by what's going on in the Middle East between Israel and Iran. So if that is the case, how far can this positive momentum be sustained then, or is this going to be a short-term movement?
I think it all boils down to the intermarket correlation directly with the oil prices. So if you look at oil prices right now, after last week movement, which is pretty much strong, so we start to see the WTI inching close to about a 6-month high, and that also broken out a key resistance level for West Texas oil at the $70.60 US dollar per barrel. So if this support level holds 70-60 in this week, potentially we may start to see a positive feedback loop in oil energy-related stocks. That includes overseas energy-related stocks as well.
Okay. Now, if we go back to the counters to watch on the SGX, Kelvin, we've got 4 REITs: Suntec Reit, ESR Reit,
yes.
Sabana Reit, and Acrophyte Hospitality Trust.
Yes.
And this is because the sponsor of all 4 REITs, ESR Group, it is expected to delist from the Hong Kong Stock Exchange on the 3rd of July. I know you don't comment on individual firms, but generally speaking, what are the motivations of privatizing a REIT sponsor in the current economic climate?
Yeah, so if you look at the nature of the REITs that is sponsored by ESR, they are more related to the retail side of the REITs that is pretty much dependent on consumer spending, and it's very cyclical, actually driven by, we call it economic growth. And in the current economic growth environment, on top of this rising geopolitical risk, it could potentially hit the rental yields of this, we call it consumer spending centric REITs. So to me, in my own opinion, it could be a defensive move from the sponsor to actually delist them from the listed exchange, and from there they are able to restructure these REITs away from public pressure.
Okay. Now, across the region, Kelvin, we want to have a look at what's going on in China, because factory output growth in China, that hit a 6-month low in May. Retail sales picked up steam. So if we look at industrial output, that grew 5.8% on a yearly basis, slowing down from 6.1% in April. And depending on, whose expectations you're looking at, and missed expectations for a 5.9% rise in the Reuters poll of analysts. Some say 5.8% growth met expectations. But that being said, if we look at retail sales rose 6.4%, much quicker than that in April, beyond a forecast as well. So how would you read into the numbers? What does it mean for Chinese equities?
I think what you could see over here, we got to dissect or decipher a bit of this mixed bag of numbers. So if you look at on the surface, yes, industrial production kind of missed the expectation. And don't forget, the reason why industrial production came in weaker than the prior month is due to the slowdown in exports growth towards U.S. because we know that industrial production has a direct correlation with exports growth for China. And on the other hand, yes, that means the external, we call it environment, now face a headwind for Chinese economic growth. But on the positive side of the things, do not forget, in the last 2 years or so, China economy has been mired in this risk of deflationary spiral, primarily caused by the weakening Chinese property market. And what's interesting over here is that on the same day today, we have the release of the housing price index, which comprises of the top 70 cities. Yes, they are still declining at 3.5% year on year, but their decline has started to slow down. What market is expecting is they're expecting to be at around 4.1%. So in fact, it came in better than expected. So there's a slowdown in these housing prices of the top 70 cities in China. And in fact, this slowdown in housing prices has taken shape since February this year. Previously for February, it was negative 4.8% year on year. Now it actually slowed down. The pace of slowdown actually hit negative 3.5%, which is, to me, is rather a positive scenario. So if this slowdown continues to actually be intact, in terms of the slowdown of the deceleration pace of the housing prices, so perhaps we may start to see at least some kind of light in the kind of a very tunnel for housing prices, housing market in China.
Okay. Now, if you're just tuning in, we're in conversation with Kelvin Wong, Senior Analyst at OANDA. Well, Kelvin, if we could stay in Asia, the U.S. is reportedly pushing Vietnam in tariff talks to reduce the use of Chinese tech and devices that are assembled in the country before being exported to America. And the ultimate objective, according to one of the people familiar with the matter, is to speed up U.S. decoupling from Chinese high tech while increasing Vietnam's industrial capacity. Now, what does this mean for both Vietnam and U.S. big techs, the likes of Apple, Meta, and Alphabet's Google that have perhaps manufacturing presence in Vietnam?
Okay, so if you look at this point in time over here, is that decoupling of we call it supply chain of Vietnam over here. So despite the fact, even though Vietnam is not a kind of a hostile country towards the U.S. point of term, but due to the fact that the input parts that Vietnam complete its finalized product before heading back to U.S. consists of Chinese component, and to get rid of this Chinese component, it takes time and effort. Number one, you need to have the technology and the skill know-how for the locals, Vietnamese, to do it. And secondly, we got to come to the point that they're able to do it effectively and efficiently. So we're talking about giving them 3 to 6 month time frame to that domain is pretty much impossible. So what we could see right now over here, it got to be a pretty much gradual process of shifting. Number one, the entire supply, we call it a chain, to be localized in Vietnam. All right, so that's take about a couple of time. And in order to speed up this process over here, costs will get involved, right? There will be some costs to be involved. So what we could see over here is that we got to be pretty much watchful in the next coming quarters, the earnings reports of these mega cap technology stocks, be it Apple, especially Apple, because they are much more consumer product centric. Whether would there be an elevated cost in making iPad and iPhones, given the fact that the U.S. government is putting much pressure on this big tech company to actually shift away their entire supply chain out from China and into a much more friendly-centric host country. And even depending on the state of how friendly the host country is, the ultimate aim is for the current U.S. White House administration to shift the entire manufacturing chain into U.S., which is pretty much of a, I would say, it's a very, very interesting way to do it here.
Okay.
Very challenging way,
Okay. Now, Kelvin, I have about 3 minutes to go, but I do want to quickly go through this question before we talk about central bank decisions. And that is the Paris Air Show. It opens today, but the mood is expected to be tempered over concerns about the recent Air India crash and the conflict over in the Middle East. So how far will Airbus instead take the center stage this time around? And will we see more action from other plane makers like Brazil's Embraer or China's Comac?
I think market participants will be watching pretty much closely. Would there be much more potential skewed towards Airbus, given, the pretty much negative, we call it fanfare or negative reaction towards Boeing in the last few months. And also market participants will be looking at the Chinese airplane maker. Would there be an increase in picking up of orders, given that the Chinese airplane maker right now seems to be in favor of the international radar aviation players' radar right now? Something to look out for,
I see. And finally, before we let you go, Kelvin, we're expecting a lot of economic data points and central bank decisions this week. So let's focus on central bank decisions. At the center of that, the FOMC rate decision and the dot plot due on Thursday. We've also got a rate decision out of Japan tomorrow, one out of England after the Fed on Thursday. What are you expecting on all three fronts?
So basically, if I look at this situation over here, is that there's going to be an increase in volatility in the FX market, given that 3 central banks are reporting their interest rate decision. So what market is expecting is more of the guidance rather than the outcome. All right. So firstly, let's start from Bank of Japan. So Bank of Japan market is expecting it to stand pat to maintain its benchmark policy rate at 0.5%. But what's interesting over here is that market want to hear from the Bank of Governor Yuda press conference thereafter, and they'll be closely examining his tonality to signal the timing and the likelihood of future rate hikes, because Bank of Japan Governor Yuda has been giving much of a balanced messaging. Number one, he's pretty much confident about the rising inflationary trend in Japan, which supports further interest rate hikes. But however, he's also pretty much concerned about the external factor that is potentially that could harm Japan's economic growth, which is primarily on the U.S. erratic way of implementing trade tariffs policy. So market is now looking at least one interest rate hike, not cut hike from BoJ before 2025 ends. Then on the other hand, over here is that Bank of Japan will also focus on the ongoing reduction of JGB purchases. So we know that JGB yield on the 30-year has been spiking up to historical high to 3.2%. That causes a further spike in other sovereign bond yields as well. So market participants right now is pretty much concerned about the ongoing pace of reduction in JGB purchase, because right now they are no longer doing QE. They are trying to temper off the QE. So at this point in time, JGB is aiming for a 400 billion per quarter reduction, and potentially due to the upheaval caused by the 30-year JGB yield last 2 weeks or so, hitting a record high. They may temper this reduction to below 400 billion. So if that's happened over here, that it could actually give a bit of reprieve to the global bond markets. And so I believe that we came short of time, right?
No, feel free to go along. I have about 1 minute if we could. Yeah.
All right. So now let me focus on, maybe we can focus on the FOM, because a lot of people talk. So let's focus on FOMC. So FOMC is very important. So we know that FOMC the Fed has been pretty much having a balanced view since the start of this year. Say they have been putting on interest rate cuts on hold since the start of this year, maintaining no change in interest rate, we call it trajectory. So last meeting, or the last meeting, they have actually this dot plot release, which is not the last meeting. In fact, the January meeting, so they release every quarterly. So the dot plot, they actually projected to have 2 more interest rate cut this year, but they will come in the later part of the year. So market, based on current market trajectory or the Fed funds future contract, they are still looking at 2 interest rate cut as well, after whatever situation that we see so far with the Israel-Iran conflict taking shape. So one to come in September, another one to come in December, 25 basis points each. So potentially you could bring down the Fed funds rate to 3.75%. So right now, market is expecting to hear very closely the tonality of Fed Chair press conference, and as well as the release of this dot plot. Would there be a change in the projection of this interest rate reduction, and also the forecast, the latest forecast on GDP growth and inflation trend in the US? So we know that ISM Services PMI, which is a leading indicator in the US, first start to show a contractionary decline in the month of April to 49.9 level. So that's the first contraction in almost a year. So whether U.S. Fed Chair Powell will address this as a sign of softening of U.S. economic growth that they have highlighted that they are in of the radar right now. So that could be a potential dovish hole instead. So with that could actually see some downside pressure on the US dollar.
I see. Thanks so much for the insights, Kelvin. That was Kelvin Wong, Senior Analyst at OANDA. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.